Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Restaurant Brands International stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 33 billion market cap. They're trading at $73 a share, and they have 453 million shares outstanding. RBI is a fast food holding company. They were formed in 2014 between the merger of Burger King and Tim Hortons. It was a deal of $12.5 billion. Burger King, an American company, Tim Hortons, a Canadian company, the merger of the giant American and Canadian fast food companies. It acquired Popeyes in 2017. They are the fifth largest operator of fast food restaurants in the world, behind Subway, McDonald's, Starbucks, and Yum. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow more than doubled from 2020 to 2021, 1.6 billion. Then it dropped 14% into 2022, it dropped another 13% into 2023. Free cash flow of 1.2 billion. I started preparing this video last week, but just yesterday they released their first quarter earnings. I'll show you their results in a little bit. Net income is the profit or loss on the income statement. It's revenue minus expenses. That goes up each year from 750 million to 1.7 billion. Pretty good margins, 24%. That means they converted 24% of their revenue into net income. And that gives them net income per share of $3.80. Each share price is $72.68. Revenue is the sales for the company, and that grows from $5 billion to $7 billion. Revenue per share is $15.51. The way you calculate revenue per share, it's revenue over shares outstanding. And they pay a high yield, 3.1%, which means they pay out $1 billion in dividends per year, which is a little less than their free cash flow, so it is affordable. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows, past year 4, that's 30 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $27 billion. We divide that by 453 million shares. And we get a calculated stock price of $60. They're trading at $73, so they're trading at a 21% premium. It's a sell according to the model. There are 53 companies in the same industry as QSR, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much on CapEx, which is surprising, 128 million. A lot less than Starbucks and McDonald's. They're a bit leveraged. Their debt-to-equity ratio is close to 5. That means for every dollar of equity, they have $4.80 of debt. They pay a nice dividend of 3.1%. Wendy's pays the most at 5%. They generate 1.2 billion of free cash flow. McDonald's is number 1 at 7.3 billion. They rank 5th in market cap, right behind Yum. Yum controls KFC, Taco Bell, Pizza Hut, and more recently the Habit Burger. They're trading at 8 times book value, a little better than the average, 19 times earnings, which is good. It's below the median average, 27 times free cash flow, between the median average, and almost 5 times revenue, a good amount worse than the median average. They generate 7 billion of revenue, and their 5-year annual revenue growth rate is 6%. Wingstop is number 1 at 25%. Just the other day, they released their first quarter earnings, and they beat revenue and earnings. The expected earnings was 720 million. They reported 730 million. Expected revenue 1.7 billion. They reported 1.74 billion. If you put $10,000 into this company 10 years ago, you'd be pretty happy. At $26,000 today, that's a 165% return and 11% annual return. After 2 years, in 2016 it looks, you would have been down. But then after that, you would have done pretty well. Just a few days ago, they released their first quarter earnings. So let's go through their results. Sales grew 8% year over year. 540 million of operating income versus 447 million. Net income grew about 50 million. It's currently 328 million. EPS up to 72 cents. International was their biggest growth, 11.6%. This is system-wide sales growth. Next is Popeyes, PLK, Popeyes Louisiana Kitchen. The next biggest is Tim Hortons, a little under 8%. Firehouse Subs, 4.3%. Burger King, the lowest, 2.6%. Their growth was much more last year. Total growth almost 15%. This year, only 8%. They do have the most sales internationally, 4.2 billion. Burger King is a second, 2.8 billion. Then Tim Hortons, then Popeyes. Here's the number of units, locations. International is the most, close to 15,000. Tim Hortons, 4,500. Burger King, 7,100. Popeyes, 3,400. Firehouse Subs, almost 1,300. Store count is down in Tim Hortons and Burger King, up in the other categories. Total revenue 1.7 billion, up from 1.6 billion. Operating income up about 100 million. Net income up about 50 million. EPS up 11 cents. Their most revenue is Tim Hortons, 224 million. In terms of operating income, Tim Hortons leads the way at 224 million. Then International, then Burger King. Firehouse Subs is the lowest at 10 million. That's up 11.1% from last year. Adjusted EBITDA, 627 million. Operating cash flow, up quite a bit, up about 50%. It was 95 million, now it's 148 million. This is just for the quarter. The first quarter of 2024 versus the first quarter of 2023. They spent 31 million in investing activities. This could be CapEx or acquisitions. An outflow of 200 million from their financing activity. This could be stock buybacks, paying a dividend, paying back debt. Free cash flow 122 million, up from 77 million. They still have lots of debt, 12.3 billion. Their net income net leverage is 7x, down from 8.3x. If you want to know the calculation, it's net debt divided by net income. So their net debt, which is debt minus cash, is 7 times their net income. So ideally, you'd like a lower ratio, so 7x is moving in the right direction. Their adjusted EBITDA net leverage, 4.8x. That's also improved a little bit from 5.1. Let's take a look at Tim Hortons. Sales, 618 million. That was last year. Now it's 637 million. Franchise property revenue, that's up a little bit, 231 million. Advertising revenue, 70 million, because the franchisees pay into a marketing bucket. When I had a franchise, I would have to pay a 10% royalty plus 2% in marketing. So 2% of my revenue had to go towards a marketing fee. It was just another way for the franchisor to get money from you. The purpose was to use the money for marketing, but we never saw much of a return from that. So total revenue, 939 million. Cost of revenue, 526 million. Expenses from their properties, 81 million. Advertising expenses, 70 million. So it looks like they spent all that 70 million they received from their franchisees. So operating income, 224 million, up from 212 million. Adjusted EBITDA, 262 million. For Burger King, restaurants went down from 7,300 to 7,100, down 2.4%. Revenue up from 300 to 350 million. Operating income 106 million. It was 96 million. Adjusted EBITDA is up also 115 to 125 million. Popeyes. Did you ever have Kenny Rogers Roasters? That was so good. That was my favorite fast food place. It's not really around anymore. I think they have some overseas, but I don't think there's any more left in the US. But I love that place and my mother got it for dinner. Popeyes added 152 stores. They're up to 3412. Revenue 178 million. Operating income 58 million. Adjusted EBITDA 67 million. All improved from the first quarter of 2023. Firehouse Subs, their smallest division, they added 44 locations. I've never been to one of these stores. Revenue 50 million. Operating income 10 million. Adjusted EBITDA 14 million. All up from prior year. Especially revenue, that went up a lot from 37 to 50 million. Mostly from advertising and other services. They added over 1,000 stores internationally. Revenue 222 million. Operating income 142 million. Adjusted EBITDA 159 million. All up from the first quarter of 2023. They're giving a 58-cent dividend for the second quarter of 2024. They reached an agreement to acquire Carroll's Restaurant Group. An all-cash deal for $1 billion. Not too cheap. $1 billion is a lot of money for this company. That should be completed in the second quarter of 2024, so as we speak. And they're using 750 million of cash on hand, and then 250 million of credit. Carroll's is the largest Burger King franchisee in the world. They have over 1,000, plus they have 55 Popeyes. They've been operating these locations since 1976 across 23 states. They did have their own business, Carol's hamburger restaurant chain, but they converted all those to Burger Kings. You could still find Carol's in Finland. And the brand was surviving up till 2012 in Finland. If you want to buy Carol's, stock price $9.52, market cap $523 million, ticker TAST. They have nice growing revenue, $1.5 billion to $1.6 billion to $1.7 billion. Currently it's $1.9 billion. And their free cash flow looks pretty good. It was negative in 2022, a pretty big positive in 2023, $79 million. Here's their consolidated numbers. Revenue $1.6 billion to $1.7 billion. Operating expenses up a little bit to $1.2 billion. Operating income $544 million, up from $447 million. Net income went from $277 million to $328 million. And they're adding shares. They had 309 million shares outstanding. Now they have 314 million. But their EPS is going up. It's up to 73 cents a share. Here's their balance sheet. $2.1 billion of current assets, $1.9 billion of current liabilities. Their biggest asset is intangible, is $11 billion. Then goodwill of $5.7 billion. So they do lots of acquisitions. $23 billion of assets, similar to last year. $18 billion of liabilities, similar to last year. Their biggest liability is long-term debt, almost $13 billion. Assets minus liabilities equals equity, $4.8 billion of equity. They raised $2.1 billion from selling their business, selling stock. They profited $1.6 billion from running their business. That's the sum of their prior net incomes minus the sum of the dividends they paid out. Accumulated other comprehensive loss of $750 million. These are unrealized losses, like pension plans or hedging contracts. Let's take a look at their statement of cash flows. The first section is operating cash flow. That was $150 million, up from $100 million. In their investing section, they had a cash outflow of $31 million, $26 million from PP&E, $23 million from acquiring restaurants, a $200 million cash outflow in their financing section. Most of that was dividends, $245 million. Let's take a look at the stock on Simply Wall Street. Its last price, 76, $33 billion market cap, up 3% in the past week, up 6% in the past year. Let's see what they say about the company. RBI operates as a quick service restaurant in Canada, the US, and internationally. It operates 4 segments: Tim Hortons, Burger King, Popeyes, and Firehouse Subs. Actually, I think this is wrong on Simply Wall Street. They have 5 segments. The 4 I just mentioned, and international. The company owns and franchises Tim Hortons, which is a chain of donut, coffee, and tea that offer blend coffee, tea, and espresso-based hot and cold specialty drinks. Also fresh baked goods, including donuts, Timbits, bagels, muffins, cookies, and pastries, grilled paninis, classic sandwiches, wraps, soups, and other food products. It also owns and franchises Burger King, a fast food hamburger restaurant chain which offers flame-grilled burgers, chicken, and other specialty sandwiches, French fries, soft drinks, and other food items. They also operate Popeyes, a quick service restaurant that provides Louisiana-style fried chicken, chicken tenders, fried shrimp and other seafood, red beans and rice, and other regional items. They also own and franchise Firehouse Subs. That restaurant offers meats and cheese, chopped salads, chili and soups, sides, soft drinks, and local specialties. Founded in 1954, 70 years ago, headquartered in Toronto, Ontario, Canada. Here's a stock price since 2014. It was $35, then it fell to $31 in 2016, then it more than doubled over the next 3 years, hitting $77. It fell to its all-time low around $31 in March 2020. 2 months ago, it hit its peak, $83 a share. It came down to $71 a couple weeks ago, but now it's trading in the mid-70s. Simply Wall Street's valuation is 62. They say the stock is 23% overvalued. 28 analysts priced this stock at 86. Their revenue forecast for this year is $7.5 billion. Next year, $8 billion. In 2026, $8.3 billion. Their free cash flow is forecasted to be $1.5 billion this year, $1.7 billion next year, then $1.8 billion in 2026. Their revenue in 2013 was only $1.5 billion. Then it fell to a little over $1 billion. Then it jumped up to $4 billion in 2015. Now they have the highest revenue ever, $7.2 billion. This red line is their debt. which you can see is a good amount higher than our equity. It wasn't that much higher in 2015 and 16, but now the gap has widened. Debt of $13 billion, equity of $5 billion. And this green line on the bottom is their cash of $1 billion. Their ex-dividend date is June 20th, so you have to own the stock before June 20th to get to the July 4th dividend. Their dividend was under 1% in 2015. It peaked at 4.7% in March 2020, mainly due to the stock price coming down, and the forecast of 2026 is 3.6%. The CEO's salary in 2017 was $600K, now it's almost $900K. Total compensation $29 million, tenure as CEO 1.2 years. In the past year, there's been only insider selling, no buying, and you can see the list goes on and on and on and on. About 400,000 shares were sold by insiders. This is just in the past year. 80% of the company is owned by institutions, 11% by the general public, 7% by hedge funds, and 1.5% by insiders. The LA company Capital Research owns 21%. Bill Ackman's Pershing Square owns 7.4%. The Canadian investment firm EdgePoint owns 3.8%, then Vanguard RBC. You'll see a lot of Canadian banks, BMO, Bank of Montreal, RBC, Royal Bank of Canada, CIBC, Canadian Imperial Bank of Commerce. TD is a Toronto company. TD stands for Toronto Dominion. Oh, it's right here, Toronto Dominion. Fiera Capital is a Canadian asset manager. Bank of Nova Scotia. Their employee count was 2,400 in 2013, way up to 9,000. And the ticker trades on the Mexican Bolsa, TSX, New York Stock Exchange, Deutsche Börse, and London Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.